Okay. So you know how we do things here on the deep dive?
Yeah,
You send us the stuff you're interested in, and we dig in.
we go deep.
Yeah, we go deep and try to pull out the interesting stuff, the important stuff. So this time you sent us the North American Construction Group's 2024 annual report.
NACG.
NACG, exactly. And this thing is a beast.
Oh, yeah.
So we're going to do our best to like boil it down, get the core, what's going on with their financials, their strategies, how they're handling safety and all that sustainability stuff.
Right.
One thing that really jumped out at me right off the bat was how different the first and second halves of 2024 were for them.
Yeah, you and me both. Annual reports, they can be a bit of a slog to get through. But I have to say, this one is pretty interesting. We're going to break it all down for you today, of course. All the key details about how NACG performed this past year and, kind of what they're signaling for 2025.
All right, so right away, in the chair's letter, he describes 2024 as somewhat Dickensian, a tale of two halves, which I thought was a pretty dramatic way to put it.
Yeah, it does kind of set the stage. And it actually is a really good way to think about their year. Because the report really does lay out those challenges, like what they call the worst of times in the first 6 months.
Yeah, so what made that first half so rough? It sounds like things were shaky right from the start with their oil sands business.
You got it. Their oil sands operations went into 2024 without much of a backlog, which obviously puts pressure on revenue, look right away. And then on top of that, demand in the oil sands sector plummeted by like 30% by the second quarter.
Wow, 30%. That's a huge hit.
Oh, yeah. That is a major swing for such a core part of their business.
So that's one problem. But it wasn't the only thing going wrong, right? It seemed like that Nuna joint venture was causing them some major headaches as well.
You're absolutely right. The report doesn't sugarcoat it either. They straight up say the Nuna joint venture's performance was poor and that it needed a complete turnaround. So clearly there were some pretty serious problems there, operational, management, who knows, but definitely something needing a big fix.
And, like on top of all their internal issues, they also had to deal with those crazy wildfires in Alberta early in the year. Just brutal timing.
Absolutely. I mean, the wildfires around Fort McMurray basically shut down operations for a while. That's a direct hit to their ability to, get work done, execute projects. And as if that wasn't bad enough, the report also mentions that the wildfires also led to higher operating costs, all kinds of knock-on effects.
Talk about adding insult to injury. And to make matters even worse, it sounds like even their partnerships weren't running smoothly in the first half of the year. Something about problems with component remanufacturing.
Yeah, they definitely had some issues there. Costs went up because of quality problems with some of their component remanufacturing partners. So you put it all together, right? Low demand in a key sector, a joint venture that's a mess, wildfires disrupting everything, problems with suppliers. It all adds up to a really, really tough first 6 months.
Yeah, no kidding. The worst of times, for sure. But the chair's letter also talked about a pretty big turnaround, the best of times emerging in the second half of the year. So what turned things around? What did they do?
Well, the report gives a lot of credit to the NACG team, for taking decisive action. One thing that really stood out was that they moved some equipment that was sitting idle in Canada over to Australia, where demand was way higher.
Smart move.
Yeah, real agile thinking. They saw an opportunity and they jumped on it. It was a great way to respond to those shifting market conditions and, find some new revenue streams.
That's awesome.
Yeah.
So what else did they do to get things back on track?
Well, they really focused on getting that Noonan joint venture sorted out. They put together what they call the right team, which I'm guessing means some changes at the top, maybe brought in some new people, and they got a lot more control over the projects and management processes. And a big win, they managed to cut down on overhead costs at Nuna. That must have been a big help.
And I'm guessing they sorted out those partnership problems, too.
Exactly. They found a new partner for component remanufacturing, and crucially, they patched things up with their biggest OEM dealer. So that probably stabilized their supply chain and helped bring costs down.
Makes sense, and it sounds like their core oil sands business picked up in the second half of the year, too, right?
Yeah, they managed to land some new long-term contracts and build up a solid backlog of work. Plus, they put a lot of effort into strengthening relationships with key players in the oil sands sector. So yeah, the second half of the year was a whole different story, a much better one.
Okay, so there you have it, the Dickensian year. Now let's zoom in on what looks to be like their biggest success story, Australia. The chairs seem pretty excited about how they're doing down under.
And for good reason. Their Australian operations absolutely crushed it in 2024. Keep in mind, this was their first full year operating there, and they managed to snag $1 billion, a billion with a B, in new and extended contracts. Pretty remarkable. I think it shows how quickly they've gotten a handle on the Australian market. Maybe their bidding process is more streamlined there, or maybe they're just operating more efficiently. It makes you wonder, what lessons they can bring back to Canada.
Yeah, $1 billion, that's a huge number. But it wasn't just the amount of contracts they won, it was also the types of projects they landed, right?
Absolutely. One that really stands out is the win at the New South Wales copper mine. Not only does that expand their geographic reach within Australia, but it also gives them exposure to a new commodity beyond, the usual coal and iron ore. And importantly, it shows that they can compete and win those unit rate contracts, which are really common in the booming Western Australia market. So it shows they're adaptable. They can work with different market structures and pricing models.
Makes sense. And it sounds like those new contracts in Australia also help them put to good use some of the equipment that they moved from Canada.
Exactly. That copper project, plus an earlier extension and expansion of a metallurgical coal project, gave them a perfect place to put the equipment they shipped from Canada. It's a really good example of how they can create synergies and be flexible across their international operations.
And the report mentioned some really impressive utilization rates for their Australian equipment.
Yeah, in the fourth quarter, their Australian assets were running at over 80% utilization. That's a really good sign. Shows that demand is strong and that they're managing their operations really well. You need that kind of high utilization to make money in this business.
Definitely. So how important is Australia becoming for Nacg overall? I know the chair mentioned some pretty striking numbers in his letter.
Well, hold on to your hat because Australia now accounts for over half of their annual revenue. And remember, this is only their first full year there. What's even more impressive is that Australia represents 70% of their total backlog and over 60% of their EBIT.
Wow, those are some serious numbers. It really shows how important Australia is becoming to their overall business.
Yeah, Australia is clearly a major growth engine for them right now.
Okay, so that's Australia. Now let's circle back to Nuna. You mentioned they managed to turn things around in the second half of the year. What were the key things that drove that improvement?
Well, the report's pretty clear that the turnaround was thanks to the new leadership team they put in place at Nuna. They came in and really tightened things up, implemented stricter controls on projects, streamlined processes, and really got a handle on those overhead expenses. And by the second half of the year, they'd brought the joint venture back to profitability. So they're hoping that sets them up for sustained growth in 2025.
That's really good to hear. It's a testament to what a good leadership team can do, focusing on the right things and making the tough decisions. Now let's talk big picture financials for 2024. What were some of the key numbers that stood out to you?
Overall, their 2024 financials tell a pretty positive story. Revenue came in at $11,165.8 million. That's up from $964.7 million in 2023. They also saw a really good jump in adjusted EPS, going from $2.83 to $3.73. And their adjusted EBITDA also saw a big increase, going from $297 million to $390.3 million. So all in all, their profitability really improved.
Yeah, those are some impressive increases. But I did notice one thing. Their net income actually went down from $63.1 million in 2023 to $44.1 million in 2024. Any explanation for that?
Yeah, good catch. So if you dig into the management's discussion and analysis, it looks like that drop in net income is mainly because of changes in the fair value of contingent obligations. Those are basically potential future payments that are tied to how well the acquired company, McKellar in this case, performs.
Oh, so it's related to their Australian acquisition.
Right. And since those estimated payments went up, it suggests they have a really positive outlook for McKellar, especially after landing all those huge new contracts. But because those future payments are now estimated to be higher, it actually hits their current net income figure. So in a way, that lower net income is actually a sign of good things to come for their Australian business.
Interesting. So, yeah, it's not as straightforward as it might seem at first glance. What about their debt levels? And how about those dividend payouts? Did those change?
Yeah, so their net debt did climb to $856.2 million in 2024. But that makes sense given all the investment they've made in Australia, buying new equipment and all that. And on the plus side, the dividend per share actually went up a bit from $0.40 to of $3.42. So, good news for shareholders.
Nice. Now, the report also had a section on their 5-year financial trends. Anything interesting there?
Yeah, taking a look back over the past 5 years, it's clear their net debt has been steadily increasing. Makes sense considering their growth. The number of outstanding shares has bounced around a bit, but has stayed pretty steady in recent years. Adjusted EPS has generally been on an upward trend after a bit of a dip a few years back. And dividends have also fluctuated, but with an increase in the latest periods. So looking at these longer term trends gives you a good sense of how they've been managing things.
Okay, cool. So that's their financials. Now let's talk about their vision for the future. Their 2025 outlook really zeroes in on three core areas: execution, sustainability, and safety. Let's start with safety, since they really seem to emphasize that it's their top priority.
Absolutely. For NACG, safety is not just a box to tick. They truly believe that it's crucial to their success. And their actions back that up. They exceeded their safety target in 2024, achieving a TRR of 0.39. Their goal was beat 0.50.
Yeah, that's impressive. And it sounds like they're not resting on their laurels either. They're really committed to getting even better.
Right. They're constantly improving their safety management systems, and they operate under the belief that all incidents are preventable. And get this, for 2025, they're planning to incorporate something called the Human and Organizational Performance Philosophy, or HOP.
HOP, what's that all about?
So HOP is a safety approach that recognizes, that humans make mistakes. It's not about blaming individuals, but about designing systems and processes that are resilient, so that mistakes don't lead to major incidents. It's pretty forward thinking.
That's really interesting. It sounds like a smart, proactive approach to safety. Okay, on to the next pillar, sustainability. What are they focusing on in this area?
Well, for NACG, sustainability is about finding that balance between environmental, social, and economic performance. So they're really focused on promoting diversity, especially increasing gender diversity at the board and leadership levels. They're also all about managing emissions, with a big focus on reducing those Scope 1 emissions through things like maximizing equipment utilization. And of course, maintaining a safe work environment with that TRIR of zero point 0.5 or less is a key part of their sustainability goals.
So it's a pretty holistic view of sustainability. It's not just about the environment, it's about people and how they operate as a business. All right, let's move on to the last pillar, execution. What's their game plan here for 2025?
When NECG talks about execution, they're basically talking about operational excellence, doing everything as efficiently and effectively as possible. They see this as the key to improving margins and delivering value to their shareholders. Their strategy involves building on their current fleet maintenance programs and using technology and innovation to get even better, become more efficient, keep costs down, and make their equipment last longer.
So it's all about maximizing the value of their assets and running a tight ship.
Makes sense. Now, the report also gave some insights into their liquidity and capital resources. What were the highlights there?
They basically broke down where their money comes from: cash flow from operations, their credit facility, and equipment financing. And they talked about how they use that money, capital expenditures to maintain and upgrade their fleet, debt repayment, dividends, and working capital. One thing that jumped out at me was that they were able to increase their borrowing limit and extend the maturity date on their credit facility, which gives them more financial flexibility.
Always a good thing.
Yeah. And they also made sure to point out that they are in compliance with all their financial covenants, specifically the total debt to bank EBITDA ratio and the interest coverage ratio. So they're on solid ground financially.
That's good to hear. Now, of course, annual reports also have to highlight potential risks and challenges. What were some of the things that NACG flagged? Well, like any company, they face a number of risks. For example, there's always the chance that some of their customers decide to start doing things in-house, which would obviously hurt their business. And then there's the fact that equipment utilization rates can fluctuate depending on market conditions. They also mentioned the risk of safety incidents, which is always a concern in their line of work. And of course, they highlighted the challenges of managing those big projects and joint ventures, and the fact that they operate in a very competitive market. So yeah, there are some definite headwinds out there.
Absolutely. It's important to understand those risks so you can get a complete picture of the company. Now, I also noticed that they mentioned something called a material weakness in internal controls, which sounds a little concerning. What was that all about?
Yeah, so it turns out they found a problem with their inventory controls within the McKellar entities, which are in Australia. Basically, they didn't have enough documentation to back up their inventory counts, which seems to have been caused by a lack of proper training in that area.
So basically a paperwork issue.
Pretty much, but they were very clear that this weakness didn't lead to any errors in their 2024 financial statements. And they've got a plan to fix it, which involves implementing their ERP system in Australia and providing better training for employees on how to do inventory control properly.
Good to hear they're on top of it. All right, let's wrap things up with a look at their outlook for 2025. What are their main priorities and what are they expecting for the year ahead?
Their 2025 plan pretty much revolves around those three pillars we talked about earlier: safety, execution, and sustainability. They're going to be focusing on frontline leadership training to enhance safety. They're aiming to continue their strong performance in Australia. And in Canada, they want to improve equipment availability. They're optimistic about both the North American and Australian commodities and infrastructure markets, which is good news. And they're planning to pursue organic growth opportunities and look into potential acquisitions to further diversify their business.
So a pretty solid strategy. Leverage their strengths in Australia, address areas for improvement in Canada, and keep an eye out for new growth opportunities. Sounds like a plan. Okay, let's zoom out and look at the big picture. What are your key takeaways from our deep dive into NACG's 2024 annual report?
Well, it was definitely a year of ups and downs. They had a really rough start, but they managed to turn things around in a big way thanks to their Australian operations and that crucial turnaround at Nuna. Financially, they're in a good spot with strong growth in revenue and adjusted earnings, even though net income took a hit because of those accounting adjustments related to the McKellar acquisition. Looking ahead to 2025, they're all about safety, sustainability, and operational excellence. And they seem to be well positioned to take advantage of those favorable market conditions in both North America and Australia while keeping a close eye on those inherent industry risks.
Yeah, it really shows that you can't just look at the headline numbers. You have to dig deeper and understand the whole story, and that's why annual reports are so valuable. They give you that in-depth perspective on a company.
I totally agree. You get a much richer understanding of not just what happened, but also what's coming down the pipe.
Okay, so for our listeners out there, as you're processing all this information about NACG, here's something to ponder. They're really going all in on Australia, and that's great. But what happens if there's a sudden shift in global commodity prices or some kind of geopolitical event that throws things off balance? How would that impact their strategy, their investments, and how they balance their operations between North America and Australia? It's a complicated question with no easy answers.
Absolutely. And, this deep dive is just a starting point. We really encourage you to check out the full 2024 annual report for yourselves. There's a ton of great information in there, and you might find things that really jump out at you, things that we didn't even touch on. It's all about connecting the dots and forming your own conclusions.
Exactly. So go forth and deep dive, listeners,
Happy reading.
and send us your next target. We'll be waiting.
Until next time.
See ya.